Welcome to Just Business Talk. Today we're diving into the world of business growth, fundraising, and exit with Ankit Shrivastava, founder and managing partner of Adventure.io. He has helped startups scale, secure capital, and navigate M&A successfully. If you're an entrepreneur or investor looking for insight that move the needles, this episode is for you. Ankit, welcome to the show.
Thanks for hosting me, Tahir. It's a pleasure to be here, and I'm looking forward to our conversation.
Thanks. Pleasure is all mine. We've been trying to organize this quite a while, aren't we?
Indeed, I'm glad that the schedule works out for us. And as I said, I'm looking forward to for an interesting conversation here.
Happy to have you here. So, Ankit, the startup growth playbook. What's the biggest mistake founders make when trying to scale their business?
Um, One of the things what we have seen in most of the startups we are evaluating as a part of our due diligence phase or deal sourcing is that a lot of founders think raising the capital and how much they raise will lead to their success. What they
Right.
don't, what we have observed that capital, the amount of capital raised is not directly proportional to the scale which they want to get.
Mm.
I think there are some underpinnings and the fundamentals what needs to be established. And one thing which I always share with our founders is that it's very important to establish the unit economics,
Mm.
and that economics needs to be established when you are at an early stage. Because
Right.
once you raise the capital, you don't have a time to fix the unit economics, and it becomes trickier and trickier. So
Mm.
that's one thing which we always tell them is like fix your unit economics, make sure that you have your product market fit being established and your value proposition is being very crystal clear. What
Mm.
makes you different are the three key criteria which we look at it, and that's where a lot of founders and a lot of startups which we have looked at it have not given enough thought to it, and that is not only having a problem for them to scale but also for them to establish themselves as to why they are different, and why should we or any VC should go and invest in them. I think
Mm.
those are the three criteria we look at it when we talk about the scale and founders. Some of the things which founders should give some consideration early on. I would not say that they are making mistakes, but if those consideration are after the fact, they should do it slightly on the left side of the time scale uh, before they get to a VC to start asking for the funding and so forth.
Right. So, fundraising strategy. What separates startups that easily secure funding from those that struggle to raise funds?
Right. Um, I think the question needs to be asked is with respect to what investor like us looks into the startup is like, do they have a validated business plan which can help them scale? Is that a long, would they be able to sustain? Should they not be able to get the money, right? With respect to investment needs to be done, given the headwind which we have, how much credit they can have and self-sustenance power they can go and do that. Um, and if they have their long-term strategy and value proposition, as I was sharing earlier, being established exceptionally well, are the people who are able to raise the capital. If they are not able to explain what their business model is, it's very highly unlikely that they will be able to get the money um, easily. They need to do go multiple rounds of it even before we get there to get the funding being done from the VCs as we speak.
Hmm. Hmm. Okay. So where is majority of your clients based are?
We Our fund actually is driven into two categories or two geographies we are looking at it. 50-50 in US and India. Those are the two geographies we are looking at it. We are looking at India being a very promising high growth uh, country as we speak, where a lot of these startups are coming in and the potential for high yield returns are there. Not
Hmm.
mentioning that we'll not get it in US, but I think India will give a whole lot of better returns than the US. But at the same time, right now it is 50-50, but the slider can move 15% in either direction as we go through the deployment process of our capital going forward.
Yeah, and what are your services include? That's including outreach of investors, and how does it work for a startup who wants to raise fund using your service?
Uh, I think if the investors are startups are looking to raise a fund with us, the best place to reach out to us with our website, which is nventure.io, where we have created a form for them to reach out to us to submit what their thesis is and share our details. And then once we do our initial assessment of product market fit and our scoring, which is like 80 points, uh, we feel pride about like we run some of our startups through 80 point before we start having the first round of conversation with them, uh, whether they are fit or not. And then we can help them not only raise the capital, but also we help them provide a hands-on advisory capability and go-to-market for if there is a scope where we can help them define what their uniqueness and what their value proposition going to be for them, not only for to raise the capital now, but also for later rounds, so that they are successful. Because some of the things which we are discussing right now, future rounds, LPs, or and even the investors look for those metrics, and that also goes to investors like us, whether we have done our due diligence enough to help them grow in that direction or not, so to say.
Or so your clients mainly are startups looking for seed capital, round one, round two. At what stage of the life cycle do you
Right.
support startups at?
Right. So, with respect to the startup stage, we our sweet spot is in pre-series A to Series B. Um, we work with incubators and accelerators while they are in early stages, where we can provide guidance and mentoring and coaching. But with respect to investments, the sweet spot where we look at is pre-series A to Series B.
Right. Okay. Investor mindset. So, what key metrics do investors truly care about when evaluating a company?
There are a few which we talked about it, unit economics, product market fit, but there are a few more. Like given that we invest in pre-series A to Series B, some of the other metrics which we look at is what is the customer acquisition cost, what is the long lifetime value of a customer's looks like, um, what is the scale look like with respect to what is the growth rate the company has gone through. And even if they are in the losses, but if they are having a very healthy growth rate, we work with them as to how to reduce your losses and get to profitability is one of our criteria as to how we can help them. Growth is growth, but growth at the expense of negative EBITDA is something which we try to avoid and help them get to a positivity or positive EBITDA. So those are three, four key metrics which we definitely look at it. And of course, that is on the quantitative side of it, but on the qualitative side of it, what's the kind of team, what the composition of the team looks like, and how we can work with them and along with them to get them to success or to the finish line, what they're looking at it.
Right. What's one sign that a business is ready to be acquired or raise capital?
So I'll split that into two parts. To be ready to raise capital versus being acquired are two different things the way we look at it. As I said, consistent growth path or growth rate in their top line are the key where we look at it. What is the growth rate versus what is their expense rate going on? If the ratio is um, if the ratio is over one between the two growth rate between and the expenses, those are the companies definitely are we are interested in making an investment.
Right.
Whether the company is ready to be acquired, I think the way we look at it, or the company we look for go and doing the acquisition, we definitely look at it whether they have a sustainable growth rate. Because early stage companies, they'll go through that very known like hockey stick growth, but at which point they go and start doing the inflection point where they start flattening what is a sustainable growth is what we look at it from an acquisition standpoint. Are the is the company with respect to their economics is valid? Is their business model is been validated and can scale? Are those some of the criteria which we look at it with respect to acquisition part of it as we go forward? Evaluate any company per se.
Right. Many founders dream of an exit. What should they do early to maximize the valuation of the company?
Uh, some of the things which we just discussed, I think a lot of as the first question I think which we were talking about, the key should be is not really to raise the money. The key is to have your fundamentals
Profitability.
of the business correct. Because the more you raise the money, the more liquidity you're going to have. End of the day,
Yeah.
when you're looking for an exit, is
Yeah.
are the founders making money? If they have like 5% left after raising X amount of millions of money, then how much they are going to get? Hardly
Mm.
anything. But if you
Exactly.
fix your fundamentals early, have the larger pool of the shares of the company being with you, I think you'll be able to make more money as a part of the exit. So focusing and considering on the fundamentals of the business is very, very important early on the stage. I think is the key. They should spend some time on and or invite someone like us who can help them look at the business a little more objectively and help them prove as
Right.
to how a scalable business can be built or business model can be implemented so that they can be get ready for exit at a higher valuation for them.
Basically, a roadmap for a startup to be profitable is very, very important. Which often the founders, especially the tech founders and high growth startups, they miss to find that when to be profitable.
Which is a good point about roadmap, and I think one of the things which we pride ourselves in our philosophy is about the execution. There
Hmm.
is always a planning bias, so to say. You can keep planning as much as you want to give yourself comfort about like, hey, I have planned and put that as a roadmap. But if you don't have a skill to execute on it effectively, ruthlessly, um, the planning fallacy always is going to be there, right? So you're absolutely correct that there has to be a roadmap, but I also I'll just extend it a bit. There has to be a skill within the company which can go and execute against that roadmap if the roadmap is solid,
True.
and which I think a lot of founders don't give that consideration a lot. Where we help, not only we invest, but we also help them execute on those plans ruthlessly so that they are ready. They may not like it initially, but that is for their own good. We help them say, hey, just trust the process as we're working through them.
Okay, so what's one red flag that instantly turns off the investors from the deal?
Um, there are many actually,
Maybe
but
the
the key
founding
ones
team?
in our say it again.
Founding team could be one.
Founding team definitely can be one, but at the same time, there are a few things. What we have seen talking to some of these founders is optimism. They're very highly optimistic.
Hmm.
It's great to be a visionary, but you need to be pragmatic about how you go about it. Optimism is important. Optimism without being backed by the data is just foolishness, for a lack of a better word. And we have seen a lot of these founders and companies as we have been evaluating them. It's like they have, hey, this is the market size. Okay, the market size does not necessarily means that that is the market you can go and tap into. So I think you rightly said about the founder, but also is about how much of optimism the founders have or the team has and how much it has been backed by the data with respect to what they have seen. So I think those are some of the qualitative and quantitative aspects we definitely have usually look at it. And if people are very ballistic about, hey, we can reach this thing, somehow that doesn't work with us.
It's good that you mentioned that optimism element of the founder. I recently had a conversation which I can relate with the optimist founder, having a revenue of, I think, few $1,000s in the
Hmm.
last 5 years, aiming to raise fund and claiming that the startup is going to be worth over $1 billion in next 2 years.
Sure.
So,
I mean, like we would like to be a part of that journey, but uh,
yeah, I
it
can
doesn't
really
work.
relate my conversation to the optimism. Yeah, I couldn't agree more
Yeah.
on this point. Yeah. So optimism, team. What about the bookkeeping and financial management of the startup?
I mean, those are table stakes, right? I mean, without that, I mean, without that, the business is definitely is not going to worth anything. But we see that as table stake, it has to be done for every single company which we look at it. But you're absolutely correct. If they are not keeping their books correct, if there are some fishy things going on, of course, those are the turnoffs. But we filter those companies out pretty early in the process as a part of what we run into or when we evaluate them. If they are not able to justify what this expense is for, which if the miscellaneous expense line item is going very high, if the account payables is going very high without receivables being high, those are some of the ratios we look at it very upfront in the process to
In
filter
your
those.
in your business model, you work on a startup or a sell side mandate or buy side mandate. On which side you work on?
So Enventure has on a private equity, we have a spectrum over here. We work with venture capital or the startup in pre-series A to Series B. We also do a buyout. So we have two funds, two vehicles, and two strategies which we have implemented. Um, so usually on a VC side of it, we work on what is the sell side mandate is going to be. We invest the money with the intent to do an exit in 3 to 4 years in any VC investment we are doing. So that is one of the things which we pride ourselves, like we are exit focused. If we don't see a path to exit in 3 years, we'll not invest, however good the company is. Because think about, I'll take an example. If a company is at valued at say $200 million, and if we are saying we are going to return our custom investors at say 5 or 6, whatever that multiple is, in 3 years, the possibility of $200 million company becoming $1 billion is far less than a company which is $20 million becoming $100 million is far more higher. So we rather invest, and our focus is to invest in the companies where we see that they can become $100 million from 20, um, $1 million on a 3 to 4 year time horizon, then 200 or $300 million company becoming 1 or $1.5 billion, which is very hard, as we have seen in the sectors which we are looking at it. So that may give you the scale factor as to where we look at it from a sell side. And on the acquisition side of it, we definitely look at it like what is the buying potential which we have when we are looking at these deals and the companies, and then whether we'll be able to make a good exit after turning around the companies in 5 to 7 years time horizon on the acquisition side of it.
So in both cases, you work along the journey of that startup. So it's
We
not a
do.
one time. It's
Uh,
not a
from-
transactional relationship that you just raise fund, take your brokerage fee, and that's it. You're gone. So
no,
you work.
no,
Yeah.
absolutely, you're absolutely correct. Is that our goal is when we do the funding, we uh, emphasize on two things. One, three things actually. One, we will take significant amount, like over 10% of the stake in the company. Two, we will need a board seat. And three, we will work with the founders to help them define what their go-to-market and their journey for next 3 years is going to look like, or 4 years going to look like. It's just not a capital deployment. We are a firm which truly believes in hands-on execution. Uh, and as I said, you can have excellent roadmap, and but if you don't have a capability to execute on it, I am not going to write, or our firm is not going to write the check for that. You need to engage us, you need to work with us, and we are open to work with you as to what that operating model can look like. And then only we have a we, and we would like to be a partner with your journey, right? Because your success is driven will drive our success, and we would like to provide every capability and service you need from a investor standpoint, that you will become successful, and we drive success for you, we drive success for ourselves.
Hmm. Great, great. So you earlier talked about the growth potential in Indian market, and so what are the current funding scenario? As I know, in this part of the world where I am in Dubai and Middle East, so the venture funding is slow at the moment. I would That's what I know. People who work in the
Hmm.
sector, that there's not
Right.
been much activity. I would assume it's not that short of capital. I think there are not been very great startups or exit stories or IPOs coming out of this region. So that might be a reason that the investors are not much optimistic or interested in investing
Hmm.
in this region. So how's the trend and the overall sentiment of investors in US and India, the markets you work in?
I, I think with investors both in US and India who we have seen are bullish in the sectors which we are investing in today, right?
Hmm.
Healthcare, which is one of the key area where we are investing in digital health. Second is about green tech or green technologies, which we are investing in India. Um, Given there is a massive problem of air pollution, water management, waste management, which is already there, which are the companies which we are trying to find it out. And the third, which we are focusing on, is on AI and B2B SaaS implementations, which we are looking at it. And we are looking at the entire value chain on the artificial intelligence and the implementations which are being done. In that particular thing, we are focusing more on B2B, and this is where investors are a whole lot bullish, both US and India, as we work through it. And there's a lot of traction. However, you are absolutely correct about exits and one of the problems which our LPs are facing, which is liquidity event, right? They have valuation on the piece of paper right now, not necessarily cash in bank. And this is where our framework, or something which we have put together as our product from an venture standpoint, is that we two things which we are guaranteeing or addressing our LP's problem. One is their money will get deployed fast, like within 90 days of their commitment, verbal commitment being done, and money being transferred to us, we'll get that deployed in 90 days. We have a very strong pipeline of vetted deals across the sector which we talk about. And two, I think, which was the theme of this conversation, is that we are not writing checks or investing in any company where we personally don't feel that we will be able to make an exit in 3 to 4 years on the venture side of it. So, which addresses the problem of our LPs' money not being deployed properly and fast enough. Like sitting in a dry powder is good metrics to have, but it's not serving anyone, at least not the LPs, which we are sort of trying to solve for. And two, given our foot on the ground in India and of course in US, we are confident about making the exits in the companies, which has a shorter path to getting to exit, like 3 to 4 years, which we're looking at it, and not holding it for a longer period of time. And I think we have currently, as we speak, we have roughly around, as of yesterday or day before or the start of this week, we had roughly around $60-65 million pipeline deal, which has already been vetted to be deployed. And then if there are investors who are looking through to your podcast, we definitely invite them to have a conversation with us, and we'll be more than happy to share those deals with them and information about it.
Right. And what are your typical investors? Private offices, private equity funds, venture capital?
So, given that we are the first time fund, there are three sets of people who we are looking at it to raise the capital from. One, definitely ultra high net worth individuals. Two is family offices across the world, is not geography dependent. And the third is the fund of funds. These are the three types of people who we are reaching out to raise our capital. We are still not ready for institutional investor. Given their check sizes are very large, right? We are raising like $100 million for PE and a $50 million for VC. Their entire first check size or smallest check size is like $50 million. So that may not work for them or not for either for us. But if there are other institutional investors who are listening to your podcast, and if they think that they can invest $5 to $10 million check to begin with, as a starting seed funding for us, we'll be more than happy to have that conversation with them.
Okay, amazing. And what are your take on AI startups? Are you also involved in that space?
Yes, I mean, I said like one of the three sectors which we have started looking at it, AI and AI's implications or the use cases in B2B sector, because that is an area where AI can deliver its promise. Not more so on the consumer side, but the adaptation of AI technology and the efficiency which you can gain from these AI is in B2B sectors or industrial sector, which we are definitely looking at it. Not only that, on the investments from a deployment on invest startups, we are using AI and tools within our investment process or life cycle as we do the due diligence or crunch our market research and data to get to the right level, what that it is, and how to evaluate the companies going forward.
All right, okay. Finally, what's the best piece of advice you would give it to the founders looking to scale and exit successfully?
Um, Three things I think I would suggest. Um, Focus on building a resilient business which is driven by a purpose. If you're solving a problem, no one can take your success away from that.
Hmm.
And one thing, and I think that was the theme of our conversation, is growth is important, but even the more important is sustainable growth. If you if you focus and you spend some time early on what that sustainable growth and the path to sustainable growth is going to look like, I think that will pay a whole lot of value to you with respect to what you're building, and investor will love you. And when you do the exit, the buying or acquiring investors will love you even more. You will deliver the impact. You will deliver the value to the society for which you're building it. So three things, as I said: resiliency, purpose-driven, and sustainable growth are the three things you should keep in consideration right up front or early on, as opposed to after the fact when you raise a lot of capital. It becomes very, very difficult thereafter.
Amazing advice, Ankit. Ankit, so finally, where our listeners, anybody who's like to work with you as an LP or as your portfolio company and talk to you about joining you, so how can they get in touch with you?
They can definitely reach out to me directly via my email, which is ankit@inventure.io, or they can reach out through LinkedIn or our websites. Every channel is open where we have our contact information. We have forms where they can reach out to us. So our website is www.inventure.io. There is a contact form. They can reach out to us. Please feel free to send me a LinkedIn request. I'm more than happy to get onto a call and learn more about what exciting things are happening in the world.
Thank you, Ankit. So, thank you so much for the listeners for being with us in this episode. Till next week, this is Tahir. I'm signing off, and we will be looking forward to speaking with our next guest next week.